Bob just got a $5,000 bonus. In 30 minutes, he's going to make a decision that could be worth hundreds of thousands of dollars 20 years from now, or cost him just as much. Bob has 9 envelopes on his desk. Every financial expert insists a different one is the answer. Bob is convinced one of them has to be the right answer. By the end of this video, you'll know exactly which combination is right for you. Let's go. Envelope number 1, Stocks and Index Funds. Bob opens the first envelope. Stocks. An index fund is like buying an entire box of 1,000 Lego minifigures instead of betting everything on just one. If one breaks, who cares? You still have 999 left. Bob invests his $5,000 at an average annual return of 8% for 20 years. It grows to roughly $23,000. He did nothing. He simply didn't touch the money. Compounding starts looking almost unfair from here. If Bob waits another 20 years, that same $23,000 grows into more than $100,000. Not twice as much. More than 4 times as much. For doing the exact same thing. Nothing. So, that's it, Bob thinks. Not yet. Next envelope. Envelope number 2, Bonds. Bob thinks bonds are boring. They are. That's exactly why retirees love them. A bond is a loan you make to a government or a company. They pay you interest in return. The expected return is lower, around 4 to 5%. But when stocks fall 30%, a diversified bond portfolio might fall only 3 to 5%. You didn't get rich, but you're also not staring at a bright red chart at 3 in the morning. Bob slips the envelope into his pocket. He doesn't throw it away, just not yet. Envelope number 3, Cash and Savings. This envelope somehow looks even more boring. A high-yield savings account paying around 4 to 5% with almost no risk. $5,000 becomes roughly $5,200 after a year. Nobody makes motivational reels about earning $200. But those $200 are much cheaper than being forced to sell your stocks at a loss because your car suddenly died. This isn't an investment, it's the safety net that lets every other envelope keep working. Envelope number 4, Real Estate. Bob wants to buy a condo in Florida because real estate always goes up. He conveniently forgot about 2008. Reality looks different. A rental property is basically a second full-time job involving toilets that break in the middle of the night, mortgage, property taxes, insurance, maintenance. One new roof for $15,000 can erase several years of rental profits with a single invoice. Real estate can build wealth, but only if Bob remembers he's running a business, not just holding an asset. Envelope number 5, REITs. Now here's the same asset without the midnight plumbing calls. A REIT lets Bob own a tiny piece of hundreds of properties instead of buying one himself. Instead of needing $300,000 to buy an apartment, Bob can start investing with a few $100s while professional managers handle the buildings. Same asset class, far fewer headaches. Envelope number 6, Gold and Commodities. Gold doesn't generate income, no dividends, no rent. It waits for everyone else to panic. There have been entire decades when gold barely produced any real return after inflation. Holding around 5% of a portfolio can act as insurance against chaos. Holding 50% often means sacrificing long-term growth for a little more peace of mind. Envelope number 7, International Stocks. Bob only buys American companies because America is where the money is. But the US represents roughly 60% of the global stock market. The other 40% is the rest of the world. If one country stumbles, Bob doesn't want his entire financial future stumbling with it. Envelopes number 8 and 9, Crypto and Individual Stocks. These are Bob's favorite envelopes. Uncle Jerry tells him about a company that's guaranteed to explode. It falls 40% in a month. Buying one stock is like stacking Lego bricks into a tower without a foundation. The difference between that and an index fund is the difference between gambling in a casino and owning a piece of the casino itself. Crypto is a similar story, just without the building. The harshest number in the entire video. If an investment loses 50%, it has to gain 100% just to get back to where it started. Keeping 5% of your portfolio here can be entertainment. Keeping 100% here can be financial suicide with a beautiful chart. Bob has now looked inside all 9 envelopes. None of them says correct. So Bob asks the question every normal Bob asks. Which one is the best? Wrong question. The best investment for next year can be the worst investment for 30 years, and vice versa. That realization cost Bob 2 years of stress. The real question isn't, what is the best investment? It's, when will I need this money? Those same $5,000. Need them next year? Cash. End of discussion. Need them in 10 years? Mostly stocks, with some bonds mixed in. Need them in 30 years? Stocks become a completely different investment. Here's why. A 30% market crash next month is a disaster if you need the money 6 months from now. The exact same crash barely matters if you won't touch the money for 30 years, because over those decades, the market has fallen many times, and historically, it has recovered each time. That's why target date funds exist. You choose your retirement year, and the fund automatically shifts money from stocks toward bonds as that date gets closer. It's not the best strategy. It's the strategy for people who don't want investing to become a second full-time job. Bob didn't learn this from a finance book. He learned it after panic selling his stocks 2 months before they recovered because he suddenly needed money for a new roof. 9 envelopes, not one winner. The asset mattered. The timeline mattered more. Before you choose an envelope, answer the question Bob should have asked first. When will I need this money? Once you know that, choosing the right combination of envelopes becomes surprisingly simple. Tell me in the comments how many years you have before you'll need your money, and I'll tell you which combination of envelopes would make the most sense.